Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing TravelCenters of America's stock by analyzing their financial statement and dissecting their financial ratios so we can determine if it's a buy or a sell. TravelCenters of America is the largest publicly traded full-service truck stop and travel center company in the US. The company is headquartered in Westlake, Ohio, and was founded in 1972. It started trading in 2007 and can be found on the Nasdaq, Deutsche Börse, and Börse Stuttgart. The company operates full-service centers, convenience stores, and restaurants under the TravelCenters of America, Petrol Stopping Centers, TA Express, Goasis, and Quaker Steak and Lube brands. A typical travel center is on 25 acres of land. It has parking for 200 trucks and 100 cars, 10 truck and 10 car fueling stations, one large travel store, and one full-service restaurant. Also, a few quick-service restaurants, truck repair and maintenance facilities. Also, there are now EV charging stations as EV trucks are getting more popular in the US. It operates in 44 states and one Canadian province. It has 272 full-service travel centers. Of those travel centers, 181 are leased, 51 owned, and 38 franchised. It started in 1972 as Truck Stops of America. It was purchased by Ryder later that year. Standard Oil of Ohio acquired the company in 1984. It was once again sold to Clipper Group in 1993. The chain merged with National Auto Truck Stops in 1997, resulting in the new name TravelCenters of America, Inc. In the late 90s, TA purchased 17 Burns Brothers travel stops, then merged with over a dozen units of Travel Ports of America. By 2000, the company had 160 locations in 40 states, with annual sales of $1.5 billion. Also in 2000, it was acquired by Oak Hill Capital Partners. In 2006, Hospitality Properties Trust agreed to acquire the company for $1.9 billion. The acquisition was completed in 2007, and TA shares started being traded on the American Stock Exchange. In May 2007, TA acquired the operating businesses of El Paso Petrol Stopping Centers and leased 40 petrol locations from HPT. The company sponsors the Truck Service Challenge competition for the Monster Energy Truck NASCAR Cup Series and NASCAR Xfinity Series. In the first quarter of this year, fuel volume increased by 11.2% since more people are getting out of their house and working or traveling. Non-fuel revenues and margins increased 5.4% and 4.7% respectively. Things are improving for TA as expected with the opening of our country. Let's get started with the model. This is a small cap company, 421 million market cap. They're trading at $29 a share and they have 15 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have positive free cash flow in 2020 for the first time, and it grew a little more in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. Revenue is the sales for the company, and that dropped a lot from $6 billion to $4.8 billion. In 2020, their restaurants were shut down for several months. Also, their fueling stations got a lot less business with less travelers and less truckers. This is the company's income statement. The top line is the revenue, the sales. In 2020, they had $4.8 billion of revenue. So about 1/3 of that came from non-fuel sales. And the thing with non-fuel sales is the margins are so much better. They had 61% margin from that. In 2020, their margins were only 16% from their fuel sales. But of course, you need to sell fuel to get people into those centers, because truckers and travelers generally go to these stops to fuel up, and of course they also eat as well. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And their gross profit didn't decline that much, even though their sales declined a lot. So they're doing a good job at managing expenses. Below that is operating expenses, and then below that is operating income. So even with much lower revenue in 2020 and the trailing 12 months, they still squeaked out a small positive in operating income. And their operating income was higher in the trailing 12 months than it was in 2019, and they had more than $1 billion lower revenue in the trailing 12 months compared to 2018. So they're definitely doing the right things to get through coronavirus and maintain profitability. They do have a lot of debt, so they pay $34 million of interest on their debt. So most years they pay more interest on their debt than they have operating income. But once they get back to $6 or $7 billion of revenue, their operating income should be higher than their interest expenses. And when their revenue gets to 8, 9, or 10 billion, then their stock will go up a lot. So the bottom line of the income statement is their net income, which is negative every year except in 2019. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They generated the most operating cash flow in 2020 and the trailing 12 months, even with a lot lower revenue. So that is impressive. A big reason their operating cash flow is higher is because they have a lot of accounts payable in 2020. Accounts payable is when you buy a product or service, but you don't pay for it. So in 2020, their cash flow is high because they didn't pay for those products, but when they do pay for them, it'll bring down their cash flow. So you shouldn't always just rely on the numbers, you have to look beneath the curtain. But even so, during COVID, to generate $244 million of cash flow when they generated $82 million in 2019 is a pretty impressive feat. They issued $80 million of stock in 2020 and $200 million of debt. So they added all this financing in 2020 just to make sure they can get through coronavirus okay. And it seems like they did a great job because they had almost $200 million of free cash flow in 2020, while it was negative in 2018 and 19. They had much higher capital expenditures in 2018 and 19. They lowered their capex in 2020 and the trailing 12 months just to maintain expenses. I'm sure they'll increase capex in 2021 and 2022. Now that things are starting to open up again, and I'm sure revenue will start coming in a lot faster. They have over $600 million of equity on their balance sheet. They generated nearly $800 million from selling capital stock, but their historical loss on their business is $147 million. But it looks like they're getting close to break even, so I imagine at the end of 2022 or 2023, they may have positive retained earnings. Let's look at the capital structure. So they have a ton of debt, $2.4 billion of debt, $600 million of equity. They're 79% debt, 21% equity. And their weighted average cost of capital is on the higher side since they're so leveraged. That's 12%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $956 million. We divide that by 15 million shares. And we get a calculated stock price of $66. They're trading at $29, so they're trading at a 56% discount. It's a strong buy according to the model. So the way I valued this company, I just took their average free cash flow for the past 4 years. That was $90 million. And then I grew it 2.5% after that. So I do think they could have higher free cash flows than this. But the company hasn't proven itself yet. They're not consistently profitable, and they did have some trouble in the past. But I do think this company has a lot of promise and a lot of potential. Simply Wall Street is on another planet. They're valuing the stock at $383. They're saying it's 92% undervalued. 2 analysts priced this stock and the average price target was $39. This is where the stock has been trading since 2007. So it does appear the stock peaked at about $220 a share. And it looks like it IPO'd at about $200 a share. Of course, that didn't happen. Usually a company doesn't IPO for that much. It IPOs around $15 to $40 a share. They did a 1-for-5 reverse stock split in 2019. So all the numbers before 2019, you need to divide by 5. So back in 2019, they were probably getting close to $1 a share. That's why most companies do a reverse stock split, so they don't go below $1 a share and get delisted. This is the stock price the last 52 weeks. So it started out about $14 in July. And it's gone up a lot. It went up to about $35, $36 at its peak. So it's been pretty steady the past several months. And this is a pretty volatile stock. Its beta is 2.19, so the stock moves more than 2 times the market. The stock has gone up over 100% in the past 52 weeks, while the S&P 500 went up 33%. The 52-week low was 14, the high was 36. And the stock is trading below its 50-day and above its 200-day moving average. When a stock trades between its 50-day and 200-day moving average, that generally means it's been trading sideways for at least 7 months now. And this stock isn't too popular. About 150,000 shares are traded each day. Of the 15 million shares outstanding, 11.5 million are on float. 54% are held by institutions, and almost 6% of the shares on float are shorted. In the past year, this stock has done really well, better than its industry and the market. But in the past 3 years and 5 years, this stock has struggled, much worse than its industry and the market. Analysts are really bullish on their earnings, expecting them to grow 92%. But analysts are only expecting their revenue to grow 6%. In the past 5 years, their annual earnings grew 12%, but in the past year, it decreased 100%. If you invested $10,000 into this company 10 years ago, you'd be up a little bit, about $11,300 today. That's only a 1.2% annual return. The biggest shareholder is Non-Tahala Capital at 9%. Then Service Properties Trust. This is a REIT. I did a video on this company. Then Portolan Capital, Goldman Sachs, and AWM Investment Company. Let's look at their financial ratios. They have negative net income, so we can't look at the PE. They have an amazing price to sales ratio of 0.1. That means investors are paying 10 cents for $1 revenue. So their revenue is about 10 times their market cap. If you're a big fan of the price to sales ratio, then this stock is an amazing buy. Maybe that's why Simply Wall Street's valuation was so high, because of their price to sales ratio. Having a good price to sales ratio is important, but you have to remember sales don't equal profit. If you can't convert those sales to profit, if your expenses are so high, you don't have much of a business and eventually you'll go bankrupt. I can tell you about a business where you'll have more revenue than Microsoft and Apple combined. The business is selling $100 bills for $95. You'll have trillions and trillions of dollars in sales. You'll have all the sales in the world, but you'll never make a profit. You'll have the best price to sales ratio of any company, but you'll eventually go bankrupt. I've seen companies with amazing price to sales ratios like 0.1 or 0.2 or 0.3 and negative net income that have gone bankrupt. I'm not saying that's the case with this company. I'm just saying it tends to be a value trap when a company has amazing price to sales ratio and negative net income. There's a reason why their price to sales ratio is so good, because why aren't more people buying the stock? It's just things you should think about and try to answer when doing your due diligence. Their price to book is also amazing. Their book value per share is $44, and their stock price is $29. So each shareholder's value of the company is $44, which is more than the stock price. So the company is worth more in bankruptcy than active. Because if the company liquidated, each shareholder would get $44, which is more money than their stock price is. They have really low operating income, so they have a terrible return on invested capital. They can just cover their interest payments with their EBIT. They have a bad ROE, and they do have a good current ratio and quick ratio. They have $500 million of cash on their balance sheet, $129 million of receivables, and $163 million of inventory. So they do seem to be well capitalized. They had over $200 million of free cash flow in the trailing 12 months, over $300 million of working capital. So they have nearly $600 million of additional funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 12 companies in the same industry as TA. And if TA has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So we can't look at their PE. They're much better in price to sales and price to book than the average. They have a higher current ratio than average. They have negative net income, so they have a negative ROE. And they're pretty leveraged, 79% debt, which is higher than average. And they're a tiny company. So to summarize, I have them trading at a 56% discount. And this company looks really good on paper, but they've taken out a lot of debt, and they really haven't had much profits with all that debt. Maybe it's coming. I know coronavirus has put a monkey wrench in all their plans. So maybe 2021 or 2022 will be their breakout year. Although the service and products they offer are highly needed, truckers and travelers need to gas up. Although they can go to any gas station, I know personally I like to go to these big travel stops because I can get gas and eat and get other things all in the same place. It is kind of annoying trying to find a gas station off an exit, then trying to find a restaurant off that exit. The company really hasn't proved it's profitable yet, but if it can eclipse that 7 billion or 8 billion revenue point, I think profitability should start rolling in. I ranked their free cash flow 7 out of 10, their revenue 6 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.